Good evening, sir. First, let me say that I appreciate being here and thank you for the opportunity to be inspired by you. Yesterday, at the Tunapuna Chamber of Industry and Commerce, the Minister of Finance alluded to the fact that banks may not be as sensitive as they should be to the needs of, or the financial needs of SMEs. My question to you, or questions to you are one.
Sorry, what did the Minister of Finance say?
Sorry, he said that banks, financial institutions, are not as sensitive as they should be to the financial needs of SMEs. My questions to you are one, do you think that banks are offering adequate financial incentives to foster growth and development of SMEs? Two, do you think that the current financial institutional framework in Trinidad and Tobago is flexible enough to offer innovative financial incentives to foster the development of SMEs? And three, if you were the managing director of a local bank, what incentives would you offer to foster the growth and development of SMEs?
It's good that you don't have a fourth. First, let me say that actually, first question, the Minister of Finance said that the banks, okay. I think that what tended to happen was that financial institutions, right, have been, over the period of time, have been very, very careful in respect of depositors' funds. And they are very, very careful, and they work under the mantra of risk and return. High risk, high return. Low risk, low return, basically. And people say, but you know, I'm a poor guy, yet I'm paying 13, 14% interest. And this other guy, he's paying 6%. I mean, this can't be fair. But from the banker's point of view, the guy who's paying 6% is no risk. Whereas the guy who's paying 14%, as far as the banker is concerned, when he looks at the profile of the person, profile of the security, profile of the business, it's very high risk. So the question, so you have that kind of, but the mantra of banks and bankers has always been safeguarding depositors' funds, safeguarding depositors' money. Developmental banks, on the other hand, in respect, what tend to happen with countries putting forward development banks and instituting development banks is for that purpose. But even they themselves have to be very careful how they lend the money. And they're not just going to be lending the money like that. And then you have the venture capital area where people want to go into it, and the venture capitalist tells you, okay, fine, this looks like a good project. You have X amount of money to put into it. I will put in X amount of money in the equity of the company. Now remember something. There's a major difference between equity and debt. Equity is high risk capital and determines, and it has to get a higher rate of return. Debt is secured. Equity is not. So debt doesn't have that amount of risk in it because it's secured. And therefore, you know, that's why debt is a fixed return on debt, which is what you call an interest rate. On the equity side of it, actually, there's no fixed return on my equity. I could lose it, or I could make a ton of money, whichever way it goes. That's all that. And that is. So the venture capitalist comes in and likes your idea and say, okay, I'll take part of the equity. Now you need equity because you can't get the debt without the equity. So you need the equity. So the venture capitalist says, I'll take 30% of the business of this, but I want an exit. So I want an exit in 5 years. I don't really want to stay in your business. But I see this as a quick way and a good way for me to make some money. So I'm going to put some money in with you. You need it, I have it. So I'm putting money in there actually and so on. But I want in 5 years, if the business does well, you're going to give me a takeout. So you either buy me out, so we have some puts and calls or whatever have you like that, instruments, and so on that you sign up for and so on. So venture capital comes in, helps with small business from a point of view of bringing equity into the company And with that pool of equity that you have, that then you then go to the bank, and you have this pool of equity, and you borrow money from the bank and so on. In the United States, there are what you call community banks. There are community banks, banks in the block, banks around the place, and so on. Sometimes they're family banks, sometimes they're ethnic banks, whatever it is. But they got these banks that collect savings from the people and would lend to that community. So within that community, they lend to their people within that community. Very regional, within certain, whatever it is, and so on. And they work through that. And I remember in the redevelopment of, I think it's was it Philadelphia, or one of these towns, where Porter did an experiment actually at some stage where they had an inner city, and they wanted to redevelop the inner city actually in respect to that, and he was able to get a lot of the banks within to come and set up some community banks. I used to be on the board of governors of BP some time ago here, actually in Trinidad, and we had a BP fund that we put up down in Mayaru, which is still existing, going great guns. Started it with $1 million for small and medium enterprises. And that went very, very well and is doing very well. And you know something? The rate of failure, it's grown quite a lot, by the way. It's grown quite a lot. The person who headed it, and I don't know if he still has it now, was Ken Gordon, actually. And Ken had a home in Mayaru, used to go down there all the time, and started. And they were tire shops. A lot of people down there. And BP felt that they needed to do something for Mayaru. Because this is where a lot of the things were coming from, and a lot of the people lived down there, etc. And they started that down there, and so on. So you could call that microfinance if you want, microfinancing. But that's what they did down there, very successful. If it was me, I would say actually that I would try to encourage more community-type banks, actually, within the region, and so on. Because a branch of Republic Bank, a branch of RBTT or RBC or whatever, and so on that, they're being driven to a large extent by shareholder pressure, and so on that, and risk, and write-offs, and various things like that. And you have to be very careful. You can't blame them, because what you don't want is another clique on these kind of situations. So you can't be all over the place and taking high risk and doing all sorts of things. So I think you want to have to be very, very careful in respect to that. And that brings up the same issue, actually, that somebody asked earlier on. You can do your corporate social responsibility, but you have to be careful that you keep it within manageable areas of what you do, of your business. So I think actually it's very important that. So to answer your question, summarize, bankers come from a special school. Okay? And their schooling is protect depositors' money, first and foremost. Don't be cavalier with it. And so then you're not going to change that thinking. All right, fine. So you need a different model for developing small and medium enterprises, and so on and that. Development, banks, yes, and so on. Venture capital, yes. Those are other institutions that can help. Because most small and medium enterprises, the problem why people can't get into business is that they don't have the startup capital. They don't have that seed capital. They don't have the equity, right? And the bank not going to lend you money without the equity, and so on. So you need that. And where do you get that from? That's what I said earlier on. Sometimes people go to the members of their family and they chuck in some money and they do it and everything like that, and so on. So I would say, look at it that way.